All right, everyone. I want to introduce you to my great friend, Mike Zlotnik. Mike Zlotnik works with Tempo Growth and Tempo Opportunity Funds. Mike and I have partnered in a few deals now. I've known him for a couple of years. Mike is a fund manager, so he specializes in investing in real estate deals, both debt and equity. Just a great guy. We think so like it's scary at times in terms of how we think without really knowing each other's background. We're always looking to mitigate risk, and he's someone I wanted to have on here to really explain. He's got a great framework on risk-adjusted returns and how to really mitigate risk. He's great at structuring deals, and this is more for the investment portion of building out your family office, how to actually become a great investor and investing outside of your business. Mike, give him a little bit of your background and let's get into the risk-adjusted stuff.
Thanks, Ray. Appreciate you. Thank you for inviting me. Yeah, I come from Russia with love, as they say in the James Bond movie. Originally, actually, from the former Soviet Union. I immigrated to the United States as a political refugee in 1989. And I've been a U.S. citizen and a U.S. Patriots ever since. So I live in New York City, family, lovely wife, 4 kids and a cat, the 5th child. Been real estate investor since 2000, full-time fund manager since 2009. That's kind of my genius zone. Love deals, love structuring deals, underwriting, networking with the sharpest minds. And that's what I do day in and day out. And funds that I co-manage are the vehicles to get investors great returns, at the same time fund the best deals that we can find. And one of the key words, the way we describe myself, I'm a capital allocator. We find the best of breed deals and we invest. And obviously, underwriting and risk-adjusted returns are all critical considerations.
Mike, talk a little bit as far as what is your current macroeconomic outlook? I know you and I kind of share similar views there. But what are you seeing out there? And because it's all about investing, is about skating where the puck is going, not where it was, right? So you want to be ahead of this and have that macro framework really drill down into your investment thesis. What are you seeing out there right now? And what's your macro outlook thesis? And again, no crystal ball, but more like, how are you viewing the world?
Yeah, if you go back a few years, you wouldn't think US would see substantial inflation, and now the world has changed quite a bit. And I am, at this point, a believer that the inflation will continue to chime along. The US kind of moved away from the deflation risk. We're more of into the inflation zone. We're not likely to hit a hyperinflation, but we will hit inflation targets probably above what the Fed was setting, the original target 2 to 2.5%. We're now well above that. And you got the street inflation and then the CPI. The CPI is already reporting pretty high numbers, and the street inflation is substantially higher. So in the inflationary environment, generally speaking, real estate that can pass through rent increases does really well. It devalues debt. It accelerates returns on equity. So at this point, we're looking to invest in projects that have good inflation hedge characteristics. So obviously, multifamily seems to be one of these sectors. In addition, we like self-storage. As you know, we've been investing quite a bit in the hotel redevelopment of multifamily. That continues to be a pretty good trend if you can get these assets at the right prices. Pretty much anything opportunistic. I mean, land continues to appreciate, so investing into land deals with the right value add strategy. So I don't like land to hold, but I do like land with a plan to improve the land. So specifically, we have some investments in land getting permitted for cultivation of cannabis. Seems to be an interesting trend. We invest with some guys who buy land for cash and sell on financing. Those are pretty interesting deals. But in general, pretty much anything that has a great location and great demographics, where the pot is going, where the people are moving, right? I mean, that's the bottom line. So I am a little concerned about certain office spaces. I'm in New York City. Office here is going to be substantially depressed for many years to come, although residential is probably going to recover. And all the hot markets in the country, Southeast kind of seems to be, South are great markets. Really opportunistic. There isn't a single asset class. As we know, we'll get into the underwriting. It's a function of a sponsor who we invest with in the strategy. Know, like, and trust the sponsor, really liking what they do, how they think, how they operate. And then underwriting the deal, making sure that the deal itself has good bones. We just did 2 more deals, just invested in 2 more deals in India. You're aware those 2 deals were the same sponsor we did Riverbend. I like the sponsor, I like the market, so we wrote a couple of checks on those deals. So again,
yeah, and we'll link guys a video of Mike and I's presentation on a deal we did together. That deal's oversubscribed. It's funded already, so there's no room in it. But we'll give you guys a sample of the deal we partnered on, did together. Within that, Mike, let's back up a second. So we both agree that asset price inflation is going to continue to ramp up. Do you see them at all raising interest rates? Because my personal bias is they could, but it would hurt them. It would hurt the market. I just don't see them raising rates materially. And if the rates raise on their own, I think they impose yield curve control and say, hey, you know what, we'll buy all the treasuries here. If the rates go above 3-4%, I think they just buy them.
Yeah, it's a great question, Ray. It's a quantitative easing, and they can push on different parts of the yield curve depending on where the rates go. The Fed will only control short-term rates, right? They can't control the rate on 10-year treasuries, but what they can do, like you said, they can buy mortgage-backed securities. They can buy 10-year treasuries.
Well, yeah, they're already buying MBS.
Yeah. So the question is, do they turn on the faucet more or less, right? And I am a proponent of a similar theory that probably they want to keep the rates low to support the economy. And if the rates start creeping up, they will probably increase some of those purchases. But I interviewed some really smart people on my podcast, and one of the key messages was that the Fed balance sheet relative to the size of the entire bond market is still small. So Fed can impact it, but they can't corner the market per se. If the market perceives a lot more risk and they're demanding high interest rates, the rates will continue to climb up with Fed not being able to completely stop the move up. If we're in hyperinflationary environment, even with the best efforts, Fed will not be able to completely slow down the rates. I mean, they'll impact them. As long as we're not seeing runaway inflation, so they'll let the rates continue to fluctuate up to some degree.
Yeah. Once it gets unbearable, my thought is it's no more quantitative easing. It's, hey, listen, we'll buy everything at 2.5% and it's not rising above this. So we're going to go so quantitative easing stops, and then, hey, we'll buy whatever the market can clear at 2.5%. So again, this happened in the 30s. They said, hey, yield curve control, we'll buy, and it's happened in Japan, it's happened in Australia. We'll just buy all the treasury at this number. Yeah,
that's a possibility. They would need to expand the balance sheet far beyond their current size, right? So if the Treasury continues to remember, U.S. budget is out of control. The Treasury needs to raise capital continuously to be able to feed the deficit, right? So they have to be buying a lot of that. Now, if the rest of the market demands higher rates, the Fed probably will have to buy a whole lot more than they're buying normally. And yeah, I mean, it becomes also a political issue how much political will there is.
Yeah. The worst part is, Mike, if interest rates, 10-year Treasury raises 3-4%, that would kill real estate values.
Yes and no, right? Really depends what's happening. I am very concerned with high interest rates because real estate trades on margin with substantial leverage and trades and the cost of capital is huge. But if we have substantial runaway inflation and incomes go up and the rents go up,
sure.
So the NOIs will go up, and even though the cost of debt service goes up, you still have valuable assets. I mean, that's your classic inflation.
So what Mike is saying, hey, if you have a job and your cost of keeping your house, your rent, everything's going up, but you're getting raises to offset that, then that's one thing. But Mike, the truth is, we haven't had real wage growth since the 70s or 80s. So you have to actually get real GDP growth above the inflation rate.
Yeah, and GDP growth above the inflation rate is difficult. I mean, we've struggled with GDP growth for many years. What you have a situation where you have artificially created inflationary environments due to the government subsidies and stimulus and unemployment benefits. So we've seen good amount of labor shortages, and as a result, higher wages in the entry level, and maybe I just call them entry all the way to sort of middle class, as benefits compete with employment. As benefits are withdrawn, the pressure on wages will slow down, and probably inflation will cool off.
And as these stimulus measures roll off, so some of these people will go back to get jobs, and hopefully that'll bring them down. But I love what you said, these artificial prices, because I feel that what's going on right now is people say, oh, inflation. You just can't talk about inflation blanket like that. What you have is asset price inflation, in my opinion, because the denominator is being messed with, right? Like in Russia and in Cuba, where both are immigrants, when they play with the currency, it's the prices of the assets are going up, like in Venezuela. right? When they mess with the Bolivar, stock prices go up through the roof, but it's not a function of real earnings and growth. It's a function of the denominator being manipulated. So right now, as they manipulate the US dollar, everything is going up, but it gives an illusion that these things are going up on their own. No, it's going up because the denominator is being devalued. And because the denominator is a US dollar against all fiat currencies, they're all going down at the same rate. It appears as if nothing's really happening, but it is. You have asset price inflation due to dollar devaluation, which is very different than just runaway inflation.
Yeah, it's sort of called stagflation, where the wages stagnate
Right.
while the asset prices are inflate. And typically it happens when the money supply increases. In the US case, a lot more dollars have gone into people's hands, and obviously people are paying higher prices for everything. So we're sort of seeing a little bit of a stagflation, but it is right now being sort of matched by real wage inflation. So we've seen massive commodity inflation. All those in the
Sure.
construction industry obviously appreciate that. That partly driven by a broken supply chain and obviously outstripping demand. But on the other side, wage inflation is real now. Will it keep up? I don't know. As the economy reopens and stimulus is withdrawn, probably wage inflation is going to slow down. While we may still see sort of runaway asset prices. What I do worry about is affordability, right? So when that ratio between average income and an average house price gets so high, I don't know how they measure it, but there's an affordability index. For example, in California, Bruce Norris has this kind of magic number. He's well known. Once the affordability index drops below 18%, so every average house, only 18% of the people can afford, you wind up with people just can't afford to buy these houses. Sure. So the downward pressure can come from that. And affordability, by the way, includes incomes and obviously interest rates. So if the interest rates climb,
it's going to affect affordability.
Big time.
Yeah. There's definitely a lot of things going on. It's very interesting. Do you have any thoughts, Mike, on if this moratorium ending of both mortgage foreclosures that I just read recently was extended till July 31st? Any thoughts on both the rent and the eviction moratorium coming to an end? Do you think that's going to create any opportunities in the housing market? And if so, where?
Yeah, I heard the Supreme Court decision to keep the moratorium in place, the CDC imposed. I mean, it's, in my opinion, it continues to be artificial controls, but it's going to be harder and harder to extend it because, the COVID is under control and there isn't enough justification to keep doing it other than sort of a political
supposedly this is the last time they extend it for both the forbearance and the eviction.
At some point when the moratoriums will end, the deadbeats, unfortunately, I don't know how else to put it, most of the US population have had support from the government and should be able to pay rents.
Sure.
But those who just don't want to pay, they choose not to pay because they can game the system.
And I would say my experience of the portfolio we have, it's about 80%, because the ones that are remaining are the ones that don't want the help, because we've even filled out the forms for them, Mike, and we just can't get a hold of them to actually do their part. So it's almost like you want to be part of this now, right? It's almost like, hey, I'm raising my hand and I'm choosing this,
Yeah, it is by choice. Right. At that point, I mean, we need this. The system needs the ability to clear out whatever you want to call it, the sludge, the non-performing stuff. Right. It's a critical part to the operation of capitalistic system. And sure. The socialist, again, I grew up in the former Soviet Union, and you had experience with the socialism and communism sure. too. Unfortunately, those systems eventually fail and they collapse because this system where the people in power strip off the economic benefits for those who work hard, it collapses the system. So in the long run, all these artificial measures need to go away. We still want to help those in need. But I think there's enough help for those in need who actually raise the hand.
Yes, you have to also be willing to help yourself. And if you're not willing to help yourself, then let's get them out. Because Mike, a lot of syndications I've invested in, a lot of deals that I'm the GP on, same thing with you, especially multifamily, haven't been able to pay out distributions, because if you have 5 to 10% of your assets under management that you cannot evict and you cannot collect, there goes your margin.
Yeah, 5% delta in the collection is huge. I mean, that's your entire margin. You're absolutely right. So
yeah. It took us on the Atlanta deal we bought pre-COVID. We'll sell it at a premium. We turned a contract to sell at a premium. We just got our first writ recently. It took us a year to get a writ. And that doesn't mean the sheriff is going to go set them out. It just means that we actually took it here. So we'll see what the next step is. But I feel like you said, I feel like we're back in Cuba. A year to get a tenant who we've tried to help out and no response, and we can't get a sheriff out there?
Right. I live in New York City. And before COVID,
No, it's much worse there.
well, I don't want to call it much worse, but it took a year pre-COVID to get somebody evicted if they didn't show up with a crying baby saying that we have nowhere to go, right? But it's
My hero.
Unfortunately, I mean, that's the reality of this world we're living in. But let's talk about risk-adjusted
Yep, sure,
returns.
let's go. Yep, I'm excited to talk about that. And high level, give them, as you pull up the presentation, Mike and I really, without talking about this, we really share a similar perspective when we look at deals. And when we talked about measuring, this is a denominator what you want to use across the board. Like we spoke about the dollar being the denominator. Here, you want to compare different assets across different spectrums. So you have to beta adjust or risk adjust them to compare investment A with investment B, right? So Mike is going to go over, I love this quadrant, Mike. So guys, Mike is a phenomenal teacher. He's got great stuff up on his website, tempofunding.com. So like, again, he's someone I learned from. And it's funny to find somebody else who just thinks the same way and is able to teach it and communicate it well.
Thank you, Ray. You're too kind. I greatly appreciate our friendship, and your words are just too kind. So let's just talk a little bit about investment quadrants. It's methodology that Robert Kiyosaki has his quadrants. I have my quadrants, and this methodology I put forward for me to better understand different investments, and real estate fits very well into this model. So let's just talk a little bit about the terms. So on the Wall Street, you have the terms called conservative investing, moderate, aggressive investing. And on the Main Street, at least what I use, I call investment grade and speculative grade. So some deals are just, I call downside protection or other safety elements. And these deals with well understood low to moderate risk with good downside protection mechanisms, they're called investment grade. And your quadrant 1 and 2 are investment grade quadrant. And your speculative grade quadrants are quadrants 3 and 4. These quadrants have limited downside protection or no downside protection, and typically higher degree of risk. When you look at the deals horizontally, now you're looking at the cash flow quadrants, which is quadrant 1 and 3. Mm-hmm. These quadrants are the quadrants that deals generate income. And we'll talk about some examples. And quadrants 2 and 4 are your growth quadrants. So these 4 quadrants, any deal that you see out there will fall into one of these quadrants. So real simple examples. Quadrant 1 deals, your first lien performing notes. You made a mortgage on a fix and flip property or deed of trust. It's pretty conservative. It's income generating, low risk. Typically, your conservatively leveraged equity deal, your multifamily syndication with the cash flow, COVID aside, with proper leverage of cheap long-term debt, would fall into quadrant 1 type of deals. Now your quadrant 2 deals are typically deals like first lien non-performing notes. So you bought a note, it's in default. It's safe because it's low LTV, but it's because it's not performing. It's a quadrant 2 deal. Also, you have some moderately leveraged value add projects. Like you said, your deal in Georgia, where due to COVID, you're not able to collect the cash flow, and you wind up with essentially a project that is appreciating through your value add work, but it's not cash flowing. Those type of deals fall into quadrant 2. And then absolutely. Quadrant 3 examples, your second lien paper. Again, second lien is just because it's junior. Most of the seconds I consider to be quadrant 3. You can have a second lien loan, a really low LTV, and be in quadrant 1. But in general, by definition, because you're in a senior position, you're in a quadrant 3. And then your highly leveraged equity deals. Instead of 70, 75% leverage, maybe you're at 85, 90% leverage, and you're cash flowing well, but if you have any issues, collection issues, you're now at a big risk point because you're over leveraged. And your quadrant 4 deals examples would be your development, redevelopment, land speculation, heavy value adds with negative cash flow. All those things are kind of fall into quadrant 4 deals. Just a lay of the land. So the returns vary by different quadrants, but in general, if you think about the quadrants, if you are essentially sacrificing cash flow, you're moving from quadrant 1 to quadrant 2. All other things being equal, you need to have a higher return target. Why? Because you're foregoing the cash flow. By the same token, if you are now taking a higher level of risk, you're moving from quadrant 1 to quadrant 3 or quadrant 2 to quadrant 4. You need to have a higher return target, because again, you are taking higher level of risk. Again, cash flow versus no cash flow. No cash flow needs to get a higher return to compensate. Lower risk versus higher risk, you need to have a higher compensation. Otherwise, why take the risk? Now, what's really important, and most folks out there, they look at the bright and shiny objects. They look at the top line projected returns, pro formas, and then they ignore risk. And that's a big concern. Just realizing that all projects have risks, even those that are in quadrant 1. And there are all kinds of risks. There's a construction risk, there's a local government zoning risk, occupancy risk, insufficient capital risk, environmental risk, local community boards and conditions, economy, just capital itself, pro forma projections versus actual results, key man risk, natural disaster risk.
How about a virus risk?
COVID, right?
Yeah.
And all those risks can create substantial disruptions to the projects. Just remember that investment grade projects generally have a lower level of risk than the speculative grade. Risk adjusted return is a holy grail. If you talk to all these sophisticated hedge fund managers and all the smart people out there, they don't talk about the top line. They always talk about risk adjusted. And risk adjustment is a complex computation. As much as the formula is really simple, understanding the risk and creating loss reserves to adjust for risk is where the complexity lies. But in general, risk adjusted return is your projected return minus your adjustment for risk or loss reserves. And the higher the risk, the higher the adjustment has to be. It really varies by the type of project. Well, this is a very complex formula behind MAF reserves, but I'm not going to spend a lot of time on this other than, in general, loss reserves, as you can see all the way on the right, is substantially higher for quadrant 3 and 4 deals. So in my MAF, again, using some examples, you can have 6 to 7% annualized, or even higher, 6 to 8%. Loss reserves for speculative projects, while your quadrant 1 and 2 deals, your loss reserves are substantially lower. And your risk-adjusted return, as you can see, you could have a top line projections for quadrant 1 being 12%, quadrant 2 being 14, quadrant 3 16, quadrant 4 19. Once you risk adjust them, they get a lot tighter because the risk level is higher. So all these speculative projects with great top line pro formas can underperform. They can collapse. You can lose all your money on the project. So you can mathematically actually compute what the risk-adjusted return is if you can go through all the variables. The challenge is you don't know what all the variables, but there is a math behind this. So again, what's the summary? Well, the summary is that your quadrant 1 and 2 need loss reserves anywhere between 1 and 3%. There's no right or wrong number. Some projects could be absolutely fine with under 1%, 0.5%. Really conservative loans could be less than 1%. But if you go into aggressive projects like quadrant 3 and 4, you gotta allocate at least 5% in my view. These development, redevelopment, land speculation deals, yeah, you could make it like a bandit, but you couldn't lose all your money. And that's why you have to adjust. So the way to think about it, hey, if everything went fine, but one of these projects failed completely, 1 out of how many? If it's 1 out of 5, you have 20% risk. If it's 1 out of 20, it's 5% risk. So you need a number, and it really depends on market conditions and many other variables. So again, risk adjusted is simple computation. Your target return, then adjustment for the risk, and then your risk adjusted number is just that. So if you take range of quadrant 1, 10 to 15%, on a conservative syndication, minus 1% loss reserves, you're in a 9 to 14% range. If you take an aggressive project in quadrant 4, promises you 18 to 24, but you're subtracting 6% for risk, then your target is 12 to 18%. That's how the math works.
And a way that I use this that's real simple for you guys to understand is, let's say, a deal we have in our Atlanta deal, right? Hey, it's a standard multifamily deal, fits in quadrant 1. It's a nice B property, nice B area. It's already cash flow producing. It's just COVID happened. We weren't able to really cash flow. So maybe it goes from investment from the way we performed it to quadrant 1, and it shifted over to quadrant 2, right? So these investments can shift, right? But the key thing too is now it's a quadrant 2 investment. Great. So if I had this investment, it's a quadrant 2 investment, and then you've got another investment. Let's say someone's going to do a heavy reposition deal in a tertiary market, right? They buy it, the building's completely vacant. They're going to come in, put a bunch of money in. Well, that would fall under quadrant 4. So let's say they're saying, hey, we're going to pay you, your returns are going to be 13, 14%. And on the Atlanta deal, it's a growth deal, you're at 11%. Well, in theory, most investors that don't risk adjust would say, hey, let me go with the higher return one, throwing the risk at the table. But really what you want to do, an investor who's risk conscious would focus on the growth deal versus the other one, because they're not getting compensated for going out further out the risk curve. So Mike and I aren't saying don't take the risk. Just make sure that you're being fairly compensated for every additional risk you're taking.
Yeah, exactly right. That's the holy grail of the whole discussion. You'll have a deal with a pro forma that, like you said, has 11% target. Another deal that has 13% target, but your 13% target is in quadrant 4. And if you risk adjusted down, its risk adjusted return is a whole lot lower than a similar deal in quadrant 2. So that's actually the essence of this whole conversation, is to be able to evaluate what level of risk you're taking. And in general, there are three categories. I have separate slide deck, but every deal has three primary ways to look at the deal. And I without all three, you almost can't invest. But what are these three? Number one is a sponsor. We'll go through the underwriting discussion in a minute. Underwriting the sponsor and getting high quality sponsor, high integrity, ability to solve problem, ability to execute the strategy. If you clear that, deal level economics, is the deal itself strong? Is it strong enough to withstand stress conditions like COVID, right? If the deal can withstand stress conditions, it's not such a bad situation when you lose the cash flow, but overall you still make it well at the end of the day when the property sells. And then the third one is obviously what I call the fair shake. Some sponsors give investors really crappy terms, but in great market, these terms work out to be good. But when things fall apart, the investors take it on the chin. So they don't take a fair shake. I mean, it's typical. I've seen plenty of these deals that cap either investor upside, or they give investors, hey, here's your 8% or 10%, and I'm only going to give you a small portion of the upside. And those type of deals I worry about because it's not a fair shake. So when you have a home run, the investors make good, but sponsor makes it like a bandit. And they need to, the better alignment of interest is critical.
So what Mike and I'll do, if you guys are interested, and let me know, I'll schedule time with Mike and we'll go over, because him and I I've never heard that framework, but it's exactly the way I think. We're always looking at the jockey. Who's the jockey we're making the bet on? And then we always want to look at the horse. Hey, is the horse a good horse, right? Can we stress the horse to make sure it's going to win? But I'll tell you what, I've seen a lot of mediocre horses with a great jockey and they do well, but I've never seen a great horse with a crap jockey do well. That hasn't worked. And then at the end, like what Mike said, are you getting a fair shake? Because a lot of times what happens, I see a lot of investors, Mike, who are new to this game and investing in syndication with partners who don't have a well network, who aren't getting a lot of pitches. They just get dealt this deal that really isn't a fair shake, where the sponsor is keeping 70, 80, 90% of the deal and the investor is putting up all the capital. That's not a fair shake. So again, you want to make sure that you're looking at a lot of pitches and getting a fair shake. And if you don't have a network, this is where someone like Mike can come in. You can invest through his fund. He's got a great network and he's going to make sure you get a fair shake because he knows what these fair shakes look like. And if not, he can negotiate them. And if not, Mike has no problem saying no.
Yeah, thank you, Rick. Kindly appreciate this nudge here. But our funds have institutional waterfalls. I mean, what we do, just to give you an idea what an institutional waterfall looks like, we pay investors typically 8% PREF, for example, in our Grail fund. And we give investors 80% of the upside or 70% depending on the class of units. I've seen the reverse true. When the sponsor takes 80%, investors get 20. And that's an unfair shake.
And Mike, you've seen that on a speculative deal. So that's one thing if it's a low risk deal, but you've seen those kind of shakes on the most riskiest deal. It's like, what are you doing? And I'm not judging. I'm just saying, like, it's silly.
Yeah, exactly. You really have to understand the deal. So that 10 or 15 or 20% equity kicker could be absolutely acceptable if you're a first lien mortgage with a good yield. I mean, we have some investments in the fund. I mentioned we actually like land deals. So we have some investments in land getting permitted for cultivation with a very competent sponsor in California. And we're getting 3 points, 12% rate and 15% equity kicker. But being a first lien lender, being senior on a capital stack, it is acceptable to take that, right? It's the risk profile on those deals is a lot lower. So I'm okay to take an additional 15% upside while I'm getting already 12% yield and some points. So from that perspective, understanding risk reward is critical. The whole
absolutely
all this computation is it revolves around risk. We can go through a couple of examples. I'm going to run through some slides quickly because I want to get to the writing. Again, Quadrant 1 deals your hard money loans at the conservative LTV. 65% used to be the good old number, now below 70%. You could do some, I've seen some of the actually owner occupied loans to non-US citizens, especially Hispanic population. They have great propensity to pay, but in general, it's a first lien mortgage. Syndication, we talked about. Your classic cash flow syndication could be multifamily, storage, obviously office industrial, and the good old days you would get year one 6% plus, and then it would improve with value add. Moderate leverage. I don't like the deals that are over leveraged. 75% is pretty much maximum leverage,
Yeah.
some reasonable asset acquisition fee, reasonable asset management fees. And your splits, you can have a decent PREF, 60-40, 70-30, 80-20, the bigger number going to the investors.
Funny that you even have to say that the bigger number goes to the investor. But it's true, you got to say it.
Because I've seen the reverse deals. I mean, it's so crazy. I've seen deals where investors put up all the money. I mean, some craziest numbers. They get no PREF and they get 40% of the upside. So the sponsor.
Mike, explain what a PREF is so that they know what a PREF is.
So PREF stands for preferred return. Typically, the way preferred return works is that after all the expenses are paid, such as management, insurance, administration, tax filing, the first 7-8%, that's the PREF, gets paid to investors. So they get, it's not guaranteed, but it's sort of the minimum number that investors will get before the sponsor will collect what is known as a performance fee. So as the deal continues to operate and make money, investors will get paid first 7% or first 6% or first 8%. In my view, one of the critical also statements is the PREF has to be cumulative. In other words, if somehow it's underpaid, and I don't know how your deals work, but if you can't distribute and you have 6% PREF, it accumulates from year 1 to year 2 and from year 2 to year 3. So what's important is if investors that own 6% in year 1, they weren't paid, and 6% in year 2, they weren't paid. Upon sale of the property, they get caught up those 6% plus 6%. Why? Because they sacrificed and they didn't get their cash. They need to get it when monetary event.
What that means is when there's any profits, you get that first. The investor gets that first before the sponsor takes his share, which is what ultimately is a fair shake. Like you're taking on the risk of investing. Any profits that come out, you get them first. You want the sponsor to be able to eat and live, but he gets paid after you get paid. So exactly. It really aligns the incentives.
Yeah, you need some kind of asset management fee to keep the lights on. But beyond that, the first distribution, that's the preferential distribution, should go to investors. There's no right or wrong number. I've seen the PREF as low as 5%, could be 6, could be 7, 8, 9, 10, 12. There's no right or wrong number. It really depends on the deal.
Right. There's a spectrum there, guys, and you want to watch that. You just generally, Mike, and again, every situation is different. Generally, you're going to want to see a 50-50 or more favored to you as the investor. And generally, I start to get a little indigestion if I see fees anywhere above 2 to 3%. Even 3% is a little high. It could be 3% if it's a really small deal, because it still has to be worth their time, like at the dollar amount, right? So that don't use the percentages as a flat thing. But when you start seeing acquisition fees in the 4 and 5% and asset management fee for 2 or 3%, and then back end fees in the sell for 2 or 3%, they're making their money off fees.
That's exactly right. So here I use example 1% asset acquisition fee. I think 2% is in line. If some situations, 3% are absolutely fine. Also depends on the size of the deal. The bigger the deal, the smaller the fee typically. Sure. So on a $100 million acquisition, 1% is $1 million and maybe sufficient. When if you are taking down, a $10 million property, they may ask for 2% or 3%. Yeah, but 4, 5, 6 is very, very steep. Yeah, just watch out for the fees. It's not just the PREF and the split, it's the fees. If the fees, you could have a wonderful waterfall with great it looks great on the surface, but if the fees start milking you. I've seen also capital raising fees. I've seen deals where they charge you a bunch of fees through a broker dealer, and the broker dealer is owned by a related party. So there's all kinds of ways people find to mask the fees and make it look like, hey, it's still a great deal for the investors. You really have to understand the sponsor, the operator, how they do their deals, their integrity. And if you start with that high quality institutional sponsor that have high integrity and they're very reasonable in fees and with great alignment of interest, it's a step in the right direction. Because if you start with the wrong sponsor, you can't even go look at any deals. Like you said, if the jockey is the wrong jockey, they'll find a way to run the horse down, right? I mean, that's the problem. Quadrant shopping centers, this was actually a presentation pre-COVID. It's funny, but shopping centers, the good shopping plazas have held up. There were some distress for time being, but a lot of the stuff is coming out pretty well.
Nope.
Anyway, so leveraged shopping plazas could do well. They typically cash flow really well. That's one of the interesting things today. If you're looking for cash flow, you may find them in some of these shopping plazas. The risk is high, of course. Retail, it's a sector that Amazon has been eating their lunch, but with the right location, could be an interesting opportunity. Again, these are just examples of deals. So Quadrant 2 deals, typically your non-performing paper below 65% LTV. The upside typically is in default interest rate, late fees. Value add syndication, it's the same as the quality cash flow syndication, except for there is no cash flow. Like with your deal went from Quadrant 1 into Quadrant 2
Right.
by virtue of COVID. But these type of deals would fall into Quadrant 2. Again, some of the distress, some of the non-performing paper, some of the deals you could be, the asset could be worth 30 to 35 million, the loan could be 16 million bucks. These are some of the live deals that we have investments with you. I think the sponsor.
Yep. We have investment with that same sponsor. And again, remember, Quadrant 2 deals are a little bit higher risk, are the same level of risk, just no cash flow. So you need an additional return to cover for the non-cash flow that you're not getting, right? If you're not going to get any cash flow, and you're going to get a payoff future than later, you want that to be higher because you're taking on additional risk there.
That's right. That's exactly right. Quadrant 3 deals, so your second lien paper. So here's an example where your first and second are below 75%. You have a high yield, but there's still Quadrant 3 deals. Heavily leveraged syndications where your leverage between 75 to 90%. Let me keep rolling forward. Quadrant 4, your development, redevelopment, heavy value adds with negative cash flow, low occupancy, land speculation. Again, another Quadrant 4 deal. Well, this resembles the deal in South Georgia.
Yep.
Again, just be very clear. So Quadrant 4 risks carry significant risks: construction delays, stop work orders, violations. When COVID hits, it's obviously a risk. Capital shortage, cost overruns, insufficient reserves, repositioning could be a stigma on the asset, and so on. So
yeah, or the market change, right? The market changes, and now financing changes. So now you can't refinance or sell like what you thought before. So a lot of these things are more into, Quadrant 3, Quadrant 4 you get into, the more risk. So you want a higher return in those quadrants. You need a higher return.
Exactly. Yeah. Yeah. Just again, summary, loss reserves. I'm going to keep rolling forward. Oh, a couple of other quick points, and then I have a few more slides. So make sure when you invest, your investments match your portfolio goals. Too many people invest into bright and shiny objects. If you don't know where you're going, how do you know you got there? Right? So having an objective, your risk reward tolerance. If you're not comfortable with Quadrant 3 and 4 deals, just stay away. Don't even have the conversation. Yeah, and your cash flow objectives. Sometimes you may have cash flow goals, and then the COVID hits, and unfortunately, you have to be prepared for stress conditions and the distribution stop. Your total return, tax efficiency, diversification, time horizon, liquidity, and so on. Your capital allocation, depending on whatever you're comfortable with, you could be more comfortable writing, half of your portfolio in Quadrant 1 and writing a little bit into other quadrants. So when you underwrite deals, it's critical to look at basically project sponsor, fund manager, and the operator. And people have asked me the question, being a fund manager, what am I investing in? And why should I invest with you? And these are really important questions, but you're underwriting the person, their team, their history, what they've been doing, their integrity. This is more important than the deal itself. If you can't establish know, like, and trust in the sponsor, you can't proceed at all. So step number 1 is sponsor underwriting. Step number 2, and by the way, one of the things we do as a fund management company, we have ourselves monitor. We use third-party administrator. We use Verivest. So they monitor all our deals. They do all the accounting and bookkeeping, and they monitor our performance, and they post all that stuff on a Verivest website. So when you are looking to invest with somebody, one of my personal preferences is when the administration is outsourced versus in-house. I'm not saying there's anything wrong with in-house administration, but it helps if you can have a third-party administrator and a potentially third-party audit. When you kind of went through the sponsor underwriting, now you got to look into the deal. And this is a complex exercise. There's many dimensions. But the number one questions that I ask is, why is this a good deal? I want to understand. I need basic, real simple explanation. Why is this a good deal? Like the deal we have with Riverbend, we know the deal was acquired for about 96 million with change. There's a little bit of $20 million investment, the reserves all in 123 million, and it's conservatively underwritten for $160 million price sale. So it's a good deal because it's a underperforming asset where the rents in that area could be a lot higher than what they were pre-project. And the property didn't have a curb appeal. So with some level of cosmetic improvements and some substantial investments in the property, you can have a lot more valuable asset because the area supports it. So that thesis, and that's an explanation why it's a good deal.
Sure.
Competent sponsor, area supports higher rents, it's underperforming, rents well below the market, the strategy could be executed. That drives the answer to the question. Why it could be a good deal? Well, it's being bought 20% below the market. Why? Because there's a big problem with the sponsor. They're in bankruptcy and a number of other problems, right? That's an explanation. Management through the value add plan, a really critical consideration, because you can have great plan and no ability to execute. If that happens,
Mike, and you and I have seen that guys that talk a good talk, and then you say, all right, here, let's get the work done, and they can't execute with a darn. I mean, that really matters.
yeah, I mean, it's a huge deal. Ability not only to execute the plan, but also manage through even now COVID. I mean, that South Georgia deal, it's finally exiting, getting investors pretty good numbers, but they're struggling managing it, and it's not their kind of strength. And from time to time, you may have a sponsor that's good at one thing, but they're not good at day-to-day grinding and dealing with the tenants and executing. And you basically have to be able to execute. Part of the value add is the execution. Obviously, risk, environmental, competition, market condition, COVID risk. I mean, appraisal, feasibility study, CMA, comps, environmental risks, all those things come into the review. Then looking at the structure and the project financial review, it's another key element. How much capital is needed, how much equity, how much debt, current financials, future projections, preferred return and performance split, year 1 through 5 projections, IRR target, fees and alignment of interest. Those are really all important considerations.
Especially the debt. How's the debt structured? How's the capital stack structured? These are key things you have to understand, because Mike and I aren't saying don't take the risk. Just make sure you understand where the return is coming from and understand what could affect that. That's why this is key. But notice that Mike has that as the number 3, and number 2 is the asset. But the first thing is, who are we making this bet on? Do I know this guy? Do I like this guy? Do I trust this guy? What's your track record?
Exactly right. So good questions to ask in underwriting. Right? Is pro forma conservative? Boy, this is like, when you look at deals, wow, people, they can put lipstick on a pig.
Yeah.
I mean, they can project revenues up, expenses down, great NOI. I mean, you got to have a pretty good understanding what the pro forma, realistic pro forma,
and just follow the incentives. They have the incentive to make that look as rosy as possible.
Because they gotta fund the deal. They gotta raise capital. Yeah. So a lot of sponsors need to market and sell the deal, and they're less concerned about presenting conservative views. They're more concerned about raising capital, and that could be a big deal because they're overpromising and they'll be very hard to deliver. Is exit valuation conservative? Cap rates? I mean, this is a big unknown. People can play the game all day long. You can make the deal look good by, say, pushing the cap rate down, and even 0.5% move in a cap rate. If you're moving down from 5 to 4.5, you can make the thing look great. What would otherwise look average.
Mike, I think that we cover all this on another call. Because you and I can go into depth on this, and then also give them an example of you and I walking through a sample deal. Like give them an example of you and I, how we look at a deal, how we actually stress it, how the cap rate affects it. And we can dive into that, like once someone brings a deal, and then kind of what we do in terms of how to make sure the sponsor is a good sponsor, how we check references and back. I want to check other investors. Like we can get into detail on that if that's something you guys want. So we'll go, because that's a whole other call in terms of what we do there and how we underwrite. Because remember, Mike and I are writing checks with you guys, in addition to you guys writing checks as well. So any deal that Mike and I are investing in, we have our own capital in there as well. I guess, Mike, in wrapping up, I want to ask you, you talk to a lot of guys, whether they're wealthy dentists or different professions, different entrepreneurs, different investors that invest with you and in your funds. What's the biggest mistake, Mike, that when you talk to someone new that you see them make, especially in investments they have already, like what do you see that stops them from obtaining legacy wealth? And it could be 2 or 3 things, but I'm sure you see a common theme.
It's a great question, and I don't have a straight answer. I almost have to think about it for a second. So, I mean, because you asked the question legacy wealth, right? And legacy wealth implies many other things. But in general, if you are talking about, I don't want to call them unsophisticated investors, but investors who are not professionals, who don't do it for a living, the primary mistake that they make is they don't invest into proper risk-adjusted return. I mean, I hate to put this again and again and again.
That's why we're covering this, dude.
They don't understand the risk. The primary mistake is they don't understand the risk, and they go through, they find a good jockey. I mean, I see this all the time. They find a decent jockey, and these really decent jockeys have done a lot of good deals, and they sometimes offer so-so terms. And when they start offering so-so terms, even great sponsors can create unbalanced deal. And when these deals don't work out and you don't have proper opportunity to catch an upside, I'll give you an example just very shortly, and then I got to run. I know a great sponsor. I really love the guy. He's an awesome guy. And he basically, his fund structure is that he pays investors 8% preferred return or interest, and then he gives investors 1/10 of the upside, only 1/10. What does he do with the money? He takes the money and he uses this as essentially equity on leveraged deal to build new homes. Now he's really good at building new homes. He's successful. His projects have done all very well. So he gives investors pro forma returns. Hey, you're going to make between 12 to 18%. Why? Because you get 8% PREF and 1/10 of the upside. But the upside is so huge, 40 to 80%. Investors never capture the big upside. If the deals do well, they're pretty much limited to 12 to 18% if things go really, really well. Primary issue with this is if this thing collapses, if something fundamental happens, right now the market is hot. Like, I mean, everything he builds, he sells for more than what he projected. Sure. So most investors are hitting the target. But if there was a problem, they're basically funding leveraged equity on the terms of a debt. The risk-adjusted composition is not right. So you're
taking equity risk for debt-like returns, and if something goes sideways, you're getting wiped out and getting nothing. There's no downside protection there if things go sideways, is what Mike is saying in other terms.
Exactly right. That's exactly the case. So these one-sided setups is the issue most investors don't realize, and the market has been a bull since we had that bottom of 2008, 2000, right? Sure. We've seen COVID fluctuation, but if you remove that, it's been a bull so long, nobody remembers big problems.
So it sounds like, Mike, one of the things that's important for these investors is become a professional investor, get educated, take the time, even if you do something else, or if not, invest with Mike. If you don't want to take that on and become professional, then find someone like a Mike to do that for you. But don't sit there in the middle where you're uneducated. And you see this generally in a lot of the B and S quadrant, very smart, like dentists, doctors, attorneys. And then you also see that in some business owners that don't have the time to do this. So they just kind of have a friend who does a syndication and they don't get a fair shake. They're not really educated. They don't understand the risks and they just send a check. Is that what the risk is? They don't take that time to either find a professional or get educated themselves.
Yeah, I mean, the primary risk is that they don't get educated. They need to make an investment and it takes a long time to build trust. So if they can't they either make the mistake of investing with the wrong people, which is the worst mistake you can make, sure. Or even if they find good people, they invest in the deals that are not really fair shake. So they're probably fine for the time being in a good market, but when the market changes, things may be very different.
Mike, if they want to get a hold of you, how do they get a hold of you?
bigmikefund.com. And if you misspell it, you forget the D at the end, bigmikefund.com. I promise it's not a kinky site. Have a good day.
Mike, I appreciate you, man. Thank you, man. Appreciate you.
Likewise.
Thank you.